Rate spikes and crises. Here we go again. How much do lending and borrowing matter? That's a hard question to answer in less than 4 minutes unless you have exactly the right chart. The full story of all the episodes I'm going to mention would fill a multi-volume encyclopedia. Yes, that's a big claim, but big evidence stands behind it. So here goes. Our graph shows the 3-month U.S. Treasury bill yield from 1956 through the present. We'll begin at the beginning, so please note this low in rates. Some 50 years passed before rates revisited that level. Here's the 4-month steel strike in 1959, which cut output by 90%. The long-term decline of the American steel industry followed. During a 10-month decline in 1962, the Dow Industrials lost more than a quarter of its value. In turn, the rise in rates carried to January 1970. The Penn Central Railroad bankruptcy followed. The Franklin National bankruptcy came soon after the rate spike into mid-1974. The late 1970s and early 1980s saw double-digit spikes in interest rates. The cluster of crises then included the peak and crash in the price of gold, plus a 50% collapse of silver in one day, the less developed country debt crisis, and the Penn Square Bank collapse. This spike in 1984 coincided with what was then the largest bank failure in U.S. history, the Continental Illinois bankruptcy. A lesser rise in rates preceded the October 1987 stock market crash. Here came the S&L and junk bond crises, then the peso crisis, and who can forget the epic failure of long-term capital management and the Asian contagion. Which brings us to this interest rate rise and the concurrent dot-com bust, plus the start of a large bear market. Now, the longer-term trend in rates by then was obviously downward, with important spikes along the way, including this one in 2007-2008. But in May 2005, the Elliott Wave Financial Forecast showed this chart through that date here, and here is a literal cut and paste of what we showed subscribers on that chart nearly 14 years ago. So what followed? The credit crisis, real estate crash, bankruptcies, and bailouts, plus the biggest stock market crash since the Great Depression. These are the highlights, so to speak, and as you can see, nearly all the memorable headline financial crises across the decades had one thing in common. Namely, they happened after a rise in interest rates. But there are 10 other events along this graph that I did not mention, so I'll show them all at once to drive home the point. Easy credit, easy credit, easy credit again and again. Easy credit is followed by a rise in rates, which is followed by declines and defaults, rinse and repeat. As for where we are now, after the Great Credit Crisis, rates declined and stayed lower, far more so than any period of easy credit on the chart, including the 1950s. Today, the end of this loose money era comes with a historic peak in positive mood. The aftermath promises to be bigger and more pronounced than any of the episodes on this chart. The history of finance is the binge and purge of the credit cycle. This chart shows you just how much borrowing and lending do matter. Stay tuned.